tools of monetary policy. So, sorry about that. Remember the first time we talked about we took a careful look at the Fed. Sorry. I have very bad allergies from yesterday. So the first time we were taking a careful look at the Fed, you may remember that we looked at their balance sheet, and on the liability side there were the Federal Reserve notes and the reserve accounts of all the banks. And that, of course, is the monetary base. It's all the currency outstanding plus the reserve accounts. How did the Fed accumulate it? It accumulated those liabilities every time it bought a bond from a bank. When the Fed buys a bond from the bank, it gets the bond, and the bank gets extra reserves or extra currency. So one tool of monetary policy for the Fed is precisely those asset purchases. You may remember that they are called open market operations. So that's the first. Open market purchase is a purchase of government bonds, mortgage-backed securities, what have you. An open market sale is the opposite. From a long time ago, there's another thing that is a potential tool of monetary policy. Remember, when the Fed was created, its job was simply to be the lender of last resort. So that if banks needed a ton of reserves in an emergency, right? If everyone wants to, normally the banks have, there's this set of reserves that the banks borrow and lend to each other as needed. But what if there's an emergency and they all want to borrow at the same time? Well, then the Fed can lend directly to them, which would be the Fed making discount loans. So that's a second tool of monetary policy. Notice that both of these involve creating new monetary base or new reserves. At the same time, there is a little difference, and I want to pause and talk about this even though we haven't finished making our list, because it's something that I notice comes up in the text a lot. Notice that discount loans, as discussed, are reserves that someone has borrowed, and so the textbook sometimes refers to these as borrowed reserves. As opposed to what? As opposed to the reserves that are created using open market operations, right? Those are not borrowed. Those are created by just buying an asset. So these are referred to as non-borrowed reserves. Or the text sometimes refers to them as NBRs, non-borrowed reserves. So keep that in mind when reading the textbook. Suddenly they start talking about non-borrowed reserves. Okay, it's reserves that aren't borrowed. That means that they're from open market operations. Borrowed reserves, I guess, is a bit more intuitive. It's the discount loans. All right, so keep that in mind when reading the textbook. I'll mention this a bit later when it comes because there's one place where the textbook harps on the issue of borrowed versus non-borrowed, and so I will talk about it a bit then. So these are forms of monetary policy that involve changing the amount of total reserves, whether it's borrowed or non-borrowed. But the Fed has other things that it controls. Notice that as well as having the ability to make discount loans, the Fed also chooses interest rates that banks have to pay on those loans. And that's different, of course, right? Choosing whether to allow banks to borrow is one thing, and choosing their price is another. And the Fed can do both. So that's a third tool of monetary policy. In fact, the interest rate, the discount rate, the interest rate the Fed charges on discount loans is not the only interest rate that the Fed controls. Remember, there's one more. The Fed also pays interest on reserves and the Fed chooses that as well. In the textbook, you'll see that the discount rate is often referred to as I with a little d on it. And the interest rate on reserves is referred to as an I with an OR next to it. Interest on reserves. All right, there's one more tool. It's a tool of monetary policy that the United States Fed central bank doesn't use very much, but some countries do. China, for example, uses this regularly. And remember that there's one more thing about the whole world of reserves, the market for reserves, that the Fed controls, and that is the required reserve ratio. This isn't something the United States Fed used. First, because it thought it had other tools that were adequate. And second, because, well, right now, the required reserve ratio is irrelevant because there's so many excess reserves out there. And third, maybe because the monetary problems that the Chinese central bank faced were slightly different. But anyway, it doesn't matter. We'll leave it on our list and we'll look at how we can put all of these together in one, hopefully consistent framework. Okay? I guess before moving on, I should say that the Fed has other tools at its disposal. For example, the Fed can also ask banks to increase bank capital, right? If the Fed thinks that banks are doing something very risky, they could tell them, you have to boost your capital, and so on. And remember, that's not monetary policy. That would be something they would be doing because they're trying to manage risk or uncertainty. So these are tools. That's a tool that the Fed can control, but it's not really a tool of monetary policy. It might be referred to as things that are to do with managing risk are sometimes referred to as macro-prudential policy. So we don't need to worry. We need to know that they exist, but we don't need to worry about them right now. Okay. Any questions or comments about this list or about anything on it? If not, then let's move to the next part, which is trying to get all of these into a consistent framework. And as discussed, this framework is going to take the form of a representation of what I referred to last class as the market for reserves. So whenever we are, as economists, representing a new market, we do two things. We have to, first of all, write the axis, where we're going to have the thing for which there's a market and the price or opportunity cost of that thing. Then we have to think carefully about who's on the demand, who's on the supply, and what are the factors that affect their behavior. So let's do that. Great. Well, this is the market for reserves. So the first thing, which is writing down what it is that this is the market for, is easy. We just write down reserves. And of course, they're measured in dollars. Next question is, what is the price here? If you get $1 of reserves, if you're a bank and you had to obtain $1 of reserves from another bank, what do you have to pay for it? Well, when you borrow $1 in reserves from a bank, you have to pay back that dollar plus interest. That interest is the federal funds rate. So that is what's going to be on the vertical or y-axis here. So those are the first pieces of our jigsaw puzzle. Then on Monday, last week, I said, let's try and think about this intuitively. First, let's think about the demand. Who is on the demand side of the market for reserves? Well, it's all the banks. All the banks need some reserves for their balance sheet. And presumably they will want more of them if they're cheaper and fewer of them if they're expensive. And so we just get a downward sloping demand curve. Let's call it D. Who is on the supply? On the supply side, we just have the Fed, right? The Fed decides how much reserves there are. They get to decide how many assets to buy and whether or not to lend to banks. So as a first pass, we can just draw a vertical line here, saying the supply of reserves comes from the Fed, and, well, they decide how many reserves there are based on factors that are not related to interest rates, because they can just create this out of thin air, almost. So now this is a basic picture. Let's see what we have as far as our tools of monetary policy. The first tool of monetary policy was open market operations. Are they represented here? Yes, they are. If the Fed buys bonds, what does it do? Well, it pays for them with reserves, so that would be an increase in reserves, which according to this picture would have the effect of lowering interest rates. So here, as usual, in these supply-demand theories, we have that the federal funds rate is determined in equilibrium by where supply and demand cross. So in the example that I was just making, if the Fed buys assets, it's paying for it with reserves. That would shift the quantity of reserves to the right because there are more reserves, and that would lower the equilibrium federal funds rate. Or alternatively, if the Fed were to do the opposite and sell assets, it gets paid for with reserves. There are fewer reserves in the world. The supply of reserves shifts left, and the equilibrium federal funds rate would rise. So, open market operations are represented in this figure. But what about the Fed's ability to make discount loans? That isn't here anymore, is it? How do we represent the Fed's ability to make discount loans in here? Well, let's think of when it is that the Fed would feel like it needs to to make discount loans. The Fed makes discount loans when all the banks are suddenly feeling the need to get more reserves at the same time, and so no one is willing to lend to each other, right? So let's see what happens in this picture as banks' desire to get reserves goes up. Why might banks desire to get more reserves? Well, maybe there's a bank panic and they're trying to get more reserves to show their customers that they don't need to worry about their funds. Or maybe they are, or maybe it's a bank panic and they're fire sales of assets. And so they need to accumulate reserves and they're doing it any way they can. So as the bank's desire to get reserves shifts to the right, we're getting an increase in the federal funds rate, right? It's increasing more and more and more. And now let's represent here, actually let's just stay with green for now, the interest rate, the discount rate. What's going to happen if the Fed funds rate reaches the discount rate? Let me say the discount rate is there. Well, the discount rate is what? It's the rate that the Fed, it's the rate that the Fed charges banks when they borrow. So what happens when the demand gets here? Well, the demand gets there. That's the point at which the banks are starting to go to the Fed and say, you know, we need more reserves. No one's willing to lend it to us. Could you please come and help? And so at that point, that's when the Fed says, okay, obviously the banks are unable to share the reserves that are out there at a reasonable interest rate. So now maybe, why doesn't the Fed lend that much, or depending on where the demand curve is, this much, to make sure the banks have the reserves they need at the interest rates that the Fed charges. So this is one way to represent, this is the way the text, I think it's a reasonable way, represents the Fed's function as a lender of last resort. In normal times, there is this, normal times, the federal funds market works in the way we've described. But in abnormal times, if the interest rates that banks charge each other is rising too much, it's going to hit this level, and that's the point at which the Fed knows, okay, the banks are panicking, I need to start lending to them, and I'm just going to lend as much as they need. Do you remember when, I think at some point earlier in the semester, I spoke about 9/11? And the chairman of the Fed at the time, Alan Greenspan, came on the radio and said to all the banks, the Federal Reserve said the discount window is open and the Federal Reserve stands ready to provide liquidity to anyone who needs it. That's the point where demand has gone over here. And the normal amount of reserves, so to speak, is no longer enough. So the Fed steps in and starts lending however much liquidity people need. All right? Any questions, comments? There is one thing that I want to mention before we move on, which is that if you look at the textbook, the label it has here is NBR. So normally, of course, the total amount of reserves is, well, it's whatever the Fed chooses to provide, which is whatever it produced with its open market operations up to this point, followed by emergency lending here. And so the way that text analyzes this is it says, you know, along here, the reserves are just basically, again, what the Fed, the bonds of the Fed bought, right? Equivalent number. These are reserves that are non-borrowed. They're generated by assets. And then any extra here must be borrowed reserves, right? When the Fed decides the banks need extra reserves, so it's going to lend to them. I think that's almost true. It's just that even in normal times, there's still some borrowing from the Fed. So in reality, this isn't only non-borrowed reserves. There may be a little bit of borrowed reserves in there. But I'm just mentioning because that is the label that this point has in the textbook. So I want to make sure you understand why it's there. The idea is, again, this many reserves are from the open market operations, and any reserves beyond that, let's say we're here, would be borrowed. All right? Because it's over and beyond what the open market operations determined. Okay? So that takes care of our second tool of monetary policy, which is making discount loans. What about the third tool? What's the third tool? The third tool was the discount rate. Well, what happens if I raise the discount rate? Well, I'm raising this threshold here, right? So that's me raising the discount rates. What happens if I lower the discount rates? Well, I'm lowering this threshold. So we can take account of that as well. Why might I want to do that? Well, suppose that we're in a situation where the banks have panicked and we are here. Right? So the demand for reserves rose, and it rose so much that the banks don't want to lend to each other and they're borrowing from me instead, me the Fed. I can help them additionally, not just by giving them more loans, but by charging them less for it, right? I lower this threshold and now the equilibrium federal funds rate, the equilibrium point is there instead. So by doing that, I would be making more loans and also making it cheaper for the banks to access them. So that's 3. What about 4? 4 was the interest rate on reserves. So how can we get that into this picture? Well, remember last Monday, I was saying that the interest rate on reserves essentially functions as a floor on the federal funds rate. How come? Well, if you're a bank and the federal funds rate is below the interest rate on reserves, why would you lend? You would earn more by just keeping your funds in the form of reserves than lending it out to anyone. You get the interest rate on reserves instead of the federal funds rate. And the way we can represent that here is by saying that this is the interest rate on reserves, and that the demand flattens out at that point. What does that mean? It means that if the Fed were providing more and more and more reserves into this market, they would still be able to buy the assets and offload their and create new reserves. It's just that the banks wouldn't be doing anything with them. They'd be just holding those funds in their reserves and earning some interest on them. Which is where we are now. We are basically here with extremely low interest rates and huge amounts of reserves just sitting on bank balance sheets, which they don't mind too much because they're earning interest on it. Any questions, comments, thoughts about this?
Repeat the last point on the interest on reserve. I think you went a little too fast, for me at least.
Okay, sure. So the interest rate on reserves, the idea is that the federal funds rate can never go below that because the banks will never lend to each other at a lower rate than that, since they can earn more than that. So imagine this, maybe I should draw an inequality so we can see it. Sophia has a question. So anything past the non-borrowed reserves is all borrowed reserves? Yes. So if you had a point here, this is non-borrowed, this is borrowed, sorry. That's Sophia's question. The other question was just to go over this again. Imagine a situation where the federal funds rate is less than the interest rate on reserves. Then anyone with reserves won't lend them, right? Because you earn more by just keeping the reserves than by lending it to someone else. So what that means is that this can't happen. You must always have that the federal funds rate is greater than or equal to the interest rate on reserves. And the way we represent that is by having the demand flatten out. So after that point, you can still increase the number of reserves in the world, or rather the Fed can still increase the number of reserves, but it's no longer affecting the federal funds rate. I mean, you can still, of course, you can still make the federal funds rate lower, right? If you were, because suppose we were there, whoops, wrong thingy. Suppose we are at this point. Let me just draw that again. So suppose that's the demand, and we are here at one point where we're actually hitting the floor. I can still lower interest rates, right? Except that the way I would have to do it is by lowering the floor. Let me do that again with a ruler. Right. Here's the demand, and then here is the floor, and here is supply. If we were at a point like that, we could still lower interest rates, but we would have to lower them by lowering the floor. So then if I lower the interest rates on reserves, then this floor goes down. Maybe use another color. And then the equilibrium rate would have gone from there to there. And that's a conscious decision. The Fed, over the past year, did actually lower the interest rate on reserves. They lowered the discount rates. They lowered everything. So that's how the interest rate on reserves fits in here. Okay? Good. Now, there's one more tool of monetary policy that we're missing, that we haven't talked about. That was the required reserve ratio. So where is the required reserve ratio here? Well, let's imagine what would happen if the required reserve ratio were to rise. And this is, again, assuming that we're in normal times when banks like to have as few excess reserves as possible. As we were discussing, if we're in a situation like this, the banks are hoarding reserves at that point to earn interest on them. Whereas in a situation like what's pictured here, where then in that case, required reserve ratio really matters to how much reserves you want. So if the required reserve ratio goes up, what does that mean? It means that the banks need more reserves, right? Demand rises. But the Fed isn't providing more reserves here, right? All that an increase in the required reserve ratio does is that it shifts the demand, and since the Fed didn't actually supply anymore, all this does is raise the equilibrium federal funds rate. So why would you do that? The Central Bank of China sometimes raises the required reserve ratio because, well, they're trying to make banks lend less. What if you're in a situation where you felt like the banks are lending too much, they may be lending to some risky projects, and you think that this poses risk to the economy? A sharp, abrupt way to stop that from happening is you raise the required reserve ratio. The banks can't lend all those funds. And one of the things it would do is raise rates. Or similarly, what if there was a giant pandemic that's disrupting supply chains and causing an economic crunch? You could do the opposite, right? You could lower the required reserve ratio, which might free up more funds for the banks to lend, thus trying to stimulate the economy. It would also lower interest rates. And lowering interest rates for the banks makes it cheaper for them to make loans to us, so our interest rates drop as well. Making it more expensive for banks to lend makes it harder for them to raise funds, which then raises interest rates on us. So all of these policies trying to move interest rates around ultimately don't just affect the banks, they also ultimately can also affect us in turn by making it cheaper to borrow, which makes it easier to spend, which may stimulate the economy, or more expensive to borrow, which makes it more expensive to spend, which slows the economy. So while we're still looking at this figure, which is a window into the market for reserves, in the background we have this idea that the Fed is often doing this because it's trying to affect real activity, the GDP, trying to stabilize GDP, stop it from swinging too high, from growing too high, which might cause inflation, or growing too slowly, which could cause deflation. And that whole other part of it is what we'll get to after the midterm. Okay, but so, in the meantime, we've successfully taken our intuition from last class, which was to think of the market for reserves in terms of demand and supply. The banks are here in the demand, the Fed is here in the supply. And we've managed to successfully incorporate into it all 5 tools of monetary policy that we started with. So for your midterm, you're going to need to familiarize yourself with this figure. So maybe you want to come back and listen to this lecture again if needed. The course is also discussed in the text. And I think in the sample midterm exam, which is on Blackboard, there should be some examples as well. Any questions, comments, thoughts? All right, good. Then the last thing to discuss, as mentioned, was that, well, in all of this we've referred to as tools of monetary policy. And so far we've been focusing on the reserves part of all of this. But ultimately, if we're changing reserves, we need to remember that reserves are part of the monetary base. And anytime you change the monetary base, you are changing the money supply. That's important because, of course, the Fed, anytime it changes any of these policy tools, is also changing the money supply. And as we've discussed, just like interest rates might have an impact on us by stimulating or slowing the economy, changes to the money supply also affect us. Because, well, let's remember, we discussed this when we talked about banking crises. If the money supply declines sharply, that makes money scarce and can cause deflation. If the money supply expands dramatically, that makes money cheap, which is inflation. And so while the Fed has to worry about how its interest rates are affecting us now, it also has to keep an eye on how this is going to affect the multiplier. This is going to affect the money supply. And if you remember, the multiplier process occurs slowly, so the impact of a change in the monetary base on the money supply may not be immediate. But it is there, and it's something the Fed needs to worry about. So let's have a look at how each of these things that we looked at, these tools in monetary policy, affect the money supply now. So first we had open market operations. And let's take an example. Let's say an open market purchase. So the Fed goes out and buys a bunch of bonds. What does that do? Well, Fed buying a bunch of bonds, as discussed, means an increase in reserves because it has to pay for them by printing more reserves. And as you can see, that means that interest rates drop, right, from there to there. Okay, let me leave that picture there for a second. You can always erase it later. So an increase in reserves shows up as there, so the interest rates drops from there to there. But what else does it do? Well, if I'm increasing the amount of reserves, I'm increasing the monetary base. And what's happening with the multiplier? Nothing. I just increased the monetary base. The banks are, nothing has happened to the demand here in particular. So the multiplier is there in the demand side. The multiplier hasn't changed. So what does that mean? It means the money supply rises. If you think about it, that means that there's a bit of a tension between what the Fed is doing now and what the Fed might do to the money supply, because you're presumably lowering interest rates now because you're trying to stimulate the economy, but you're also raising the money supply. And as discussed, raising the money supply sooner or later may translate into inflation. And what does inflation do to interest rates? It raises them. So that suggests two important things that we'll have to keep in mind later on when we're thinking about the macroeconomic impact of monetary policy. One is that it suggests that this interest rate change has to be only temporary. Because eventually, when it generates inflation, the interest rates will go back up again. Another thing it suggests is that, again, there's this tension here between doing something now and what may happen later. You can lower interest rates now, but if you create too much inflation, you'll raise rates later. Although, strictly speaking, remember that what matters for interest rates is not inflation itself. It's expected inflation. And so that means that, again, when we get past our midterm and start thinking about the macroeconomic impact of monetary policy, we'll have to spend a lot of time thinking carefully about how is expected inflation determined? What determines expected inflation in people's minds? That's such an important topic that several people won Nobel Prizes for it. A couple of decades, well, 15 years ago by now, I guess. More like 20. Anyway, that's open market operations. Second, what about discount loans? Let's say the Fed decides to make more discount loans. What's that going to do? Well, if the Fed makes more discount loans, what happens? Well, if the Fed just decided to make more discount loans today, depending on where we are in this whole picture, let's draw a picture again. Actually, let's discuss this together with the interest rate on discount bonds. If we're in this situation, which is what I call normal times, there's not really much role for discount loans, right? For discount loans to really matter here, we would have to be in a situation like that. In a situation like that, lots of things are going on at once, right? On the one hand, if you make more discount loans, you're increasing the monetary base, which would suggest something like this. You're increasing the monetary base, so you're increasing the money supply. But of course, if we're in this situation here, where the banks need all these extra reserves, chances are, well, because the demand for reserves has risen so much, the demand for reserves suddenly rises. That means the banks suddenly need a lot of more reserves, which means they're probably slashing their reserve ratios. Sorry, dramatically increasing their reserve ratios. What they're slashing is lending. They're slashing lending because they feel too much risk, increasing their reserve ratios, and so that means that this would be happening at the same time as the multiplier is going down. That's how do we write that? Usually happens when the multiplier is going down. So then the impact on the final impact on the money supply is less clear. Not because of the impact of the loans, but because the Fed tends to make these loans in crisis situations. Right? What about cheaper loans? I'd say the same thing, right? If we're in a situation where discount loans matter at all, and the Fed makes cheaper loans, it's a situation where, well, they're lowering the interest rates. That's clear. And they're boosting the monetary base and they're boosting the money supply, therefore. But again, this is happening at the same time that banks are desiring to hold much higher reserve ratios. So the ultimate impact on the money supply is unclear. Although I guess it should be clear that changing the discount rates is a more drastic thing than changing discount loans. You're not just giving lots of loans, you're also making them cheaper. So you're really giving a lot of room to the banks. What's our next tool? It's the interest rate on reserves. And what if you lower the interest rate on reserves? What's going to happen? Well, what are you doing when you do that? If you're lowering the interest rate on reserves and it actually matters for anything, it means we must be somewhere here, right? So if you lower the interest rate in reserves, you're not actually changing anything in terms of the monetary base, right? You're just changing how much you're paying the banks. I guess the only problem would be if you lower them so much that they don't want to hold these all these extra reserves anymore. But in any case, it should be clear that since changing the interest rate on reserves changes how happy the banks are to hold those reserves, but it's not clearly having a direct impact. Whoops. Or a marginal impact, I guess, on the monetary base. Finally, our friend, the required reserve ratio. Let's see, suppose they lower the required reserve ratio. What does that do? The monetary base is not affected, as discussed, but it lowers the multiplier. Sorry about that. A lower reserve ratio raises the multiplier. Remember, there's a mnemonic for that, because in the case when there is no currency, the formula for the multiplier is 1 over the reserve ratio. If we're in normal times, there are not many excess reserves, and so lowering the reserve ratio raises the multiplier. Of course, if you're raising the multiplier, you're raising the money supply. So again, lowering the reserve ratio, as discussed, because it raises the multiplier, it's lowering the demand for reserves. That lowers the federal funds rate and increases the money supply. So the tension here between interest rates now and potential future inflation, because of the increase in the money supply, is still there. Again, emphasizing that with all these tools, in normal times, there's this tension between what you're doing now with interest rates and the inflation that you may create later. These three tools are only important in extreme times, and in those cases, it's a little less clear whether there's this trade-off with future inflation. Any questions, comments about this? Well, if not, then let's quickly take stock of what we discussed. First, we made this list of the 5 key tools of monetary policy. Then we thought first about how they might affect interbank rates, and keeping in the back of our minds that anything that changes the federal funds rate is eventually going to have a knock-on effect on other interest rates. So it can be used as a way of stimulating or slowing the economy. We looked at how to represent all of these in the market for reserves. And then, just now, we just also had a separate look at how each of them might affect the money supply. And it looks like, at least in normal times, there's this little tension between lowering interest rates now versus possibly raising them in the future through changes in expected inflation. So the key thing here is going to be what determines expected inflation. And that's going to always be I guess I'll just say that's a key puzzle in understanding macroeconomics. It's a key thing that macroeconomists struggle to understand, because it's hard to, it's one thing to measure expected inflation. It's another thing to understand exactly how those expectations are formed. And that's going to be our challenge after the midterm. Excellent. 3, 2, 1. First question of 9. What is the y-axis label in this picture? What is y? Federal funds rates, interest rate on reserves, equilibrium federal funds rates, or the discount rates? It is the federal funds rates. Very good. Question 2. What is the x-axis label in this picture? Money supply, bonds, reserves, or borrowed funds? It is reserves indeed. It is not the money supply. This is the market for reserves. Remember that. Good job, Alexandra. What is label A in this picture? Is it the federal funds rates, the interest rate on reserves, the equilibrium federal funds rates, or the discount rates? It is indeed the discount rates. It's the ceiling on the interest rates. Next, what is label B? federal funds rates, equilibrium federal funds rates, interest rate on reserves, or discount rates. One second left. It is the equilibrium federal funds rates. It's where the two cross, the demand and the supply. All right. What is the label C in this figure? Equilibrium federal funds rates, discount rates, federal funds rates, or the interest rate on reserves. It is the interest rate on reserves, the floor, below which no one will lend to each other. 6 of 9. What happens if banks desire more reserves? Does B rise? Does B fall? Does A rise, or does A fall? If banks desire more reserves, they push up the demand, and that raises the equilibrium federal funds rates. 7 of 9. Isn't that a Star Trek character? In a banking crisis, what happens if the Fed does nothing? Does B rise? Does B decline? Does A rise, or does A decline? In a banking crisis, what happens if the Fed does nothing? In a banking crisis, banks demand more reserves, which means they raise the equilibrium federal funds rates. 8 of 9. If the Fed performs an open market purchase, what happens here? Does B rise? Does B decline? Does A decline, or does C rise? An open market purchase. An open market purchase is a shift to the right in the supply curve, so the federal funds rate declines. And last of all, if the Fed buys trillions and trillions of dollars in bonds, eventually what will happen? Does B rise? Does B decline? Does A decline, or does C rise? Good. B declines to C, correct. Most of you. Let's see. Third place is Alexandra C. Good job. Second place is Marshall. And first we have Sophia. Good job. All right, Sophia. What awful thing would you like me to do with Snapchat, or humorous, or whatever?
Can you do like a different type of dog filter? I know you did like one before, but can you see like what different types there are?
Okay, let's see. Now I am a dog with a croc on its head, apparently.
Yeah, that's good.
Yeah. It seems the dog ones haven't been, they need to work on the dog filters a little more, I think. But anyway, all right. Thanks very much. I hope that was useful. Please review this topic because it will be on your midterm. I will send you the Kahoot link later because that might actually be a useful way of doing so in this case, as well as reviewing the the sample midterm. All right, thanks everyone. Take care. All the best, and talk to you next week, if not before. Bye, everyone.